DRDGold recently released its third quarter results. CEO Neil Pretorius gives us insights into these results.
Our business is sensitive to both volume and metallurgical efficiency. Those are the two key drivers. So if you get that right, then the results are going to look good. We were off to a slow start at the beginning of the quarter, obviously with it being rainy season and also with load shedding, just absorbing the impact of load shedding initially. Also just starting up with the second and the third stream of our fine grind circuit, the flotation circuit and the fine grind circuit, so that took a little time to settle in as well. But then towards the end of the quarter, the middle of February through to the end of March, things really accelerated and came together quite nicely. So it was the combination of really good volume throughput and very good metallurgical efficiency towards the end of the quarter. I don't think gold's going to go up by much, if at all. Maybe it can soften even a little bit more, depending on sentiment on the dollar. The rand has been weak, though. The rand has lost quite a bit of value against the dollar, and because most of our suppliers are now supplying us with local manufacturing cost pricing for the price of the product, we're actually taking advantage, or we are getting the advantage or the benefit of a slightly weaker local currency. In the past, with import parity pricing, that was a different story. We've also got wages locked in for another year, so our costs are fairly steady and predictable, and we haven't seen sharp increases in all-in cost, the total cost. So I think if one can just keep on managing that properly, the rand price of gold is not bad at all. In fact, it is still quite favorable, and hopefully we can continue to take advantage of that. If the ratio or the relationship between dollar, rand and gold, if that stays the same, if there's not a decoupling and a recoupling at a different level, I think South African gold miners are in a relatively good spot, sweet spot, and long may it last. If there is going to be a movement in the gold price, I foresee that it's probably going to be in about 24 months, maybe 18 to 24 months, and that'll simply be as a consequence of international producers not really spending enough capital, not enough new projects being developed, and if current consumption demands stay flat, then there might be a bit of pressure on gold supply at the time, and that could cause the gold price to rally.
For Creamer Media's Mining Weekly, I'm Ilan Solomons, reporting from JSE, Sandton.